Good day, ladies and gentlemen, and a very warm welcome to the Indiabulls Housing Finance Limited Q4 FY19 earnings conference call hosted by UBS Securities Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now have the conference over to Mr. Ishank Kumar from UBS Securities. Thank you, and over to you, Ishank.
Thank you. Hi, everyone. Thanks for joining this call. We welcome the management of Indiabulls Housing Finance to discuss Q4 FY19 results. From the management team, we have Mr. Gagan Banga, Vice Chairman, MD and CEO, Mr. Ashwini Huda, Deputy Managing Director, Mr. Sachin Chaudhary, Chief Operating Officer, Mr. Mukesh Garg, Chief Financial Officer, Mr. Ashwin Malik, Head Treasury, Mr. Ramnath Shenoy, Head Investor Relations and Analytics, and Mr. Harshil Suvankar, Head Markets. I now invite Mr. Banga to share the key detail of the results. Over to you, Gagan.
Yeah, a very good day to all of you and welcome to the Q4 and full year fiscal 19 earnings call. In the second half of fiscal 19, we've raised over rupees 50,000 crores of monies and focused on elongating our liability profile and shoring up liquidity. Our disbursals are now back at normal levels, and we disbursed as much as 2 times of what we disbursed in Q3 fiscal 19 at rupees 7,300 crores. Despite this disbursal, we have now over rupees 30,000 crores of ready liquidity available with us, the details of which have also been shared in the earnings update. Some of this 30,000 crores is growth capital that we've kept ready for pursuing the growth opportunity in fiscal 20, and this will allow us to meet and exceed our normal disbursal run rate, as well as to meet all liability repayments and still be left with ample growth capital at the end of Q1 fiscal 20. Thus, we now look to step up growth, and we are disbursing at our regular pre-September 18 levels. And as we would like to reiterate, as we did in the previous quarter, that we are looking to grow the AUM at about 20% levels now. In these past 6 months, we've raised as much as 51,312 crores during this period, spread across different sources of funding from 25 banks, 13 mutual funds, and 6 insurance companies. In all now, we have 658 strong relationships, 21 PSU banks, 26 private and foreign banks, and 611 mutual funds, provident funds, pension funds, insurance companies, and corporates. Since 21st September 2018, when the crisis began, we raised funds from the following sources: bank loans of 14,477 crores, bonds of 5,500 crores, securitization of over 21,000 crores, and commercial paper of around 10,000 crores, the outstanding stock of which is around 5,000 crores. These funds were raised from the most marquee names in the country, including top private sector banks, public sector banks, largest of the mutual funds, and largest financial institutions. Going ahead, it is this nimbleness to shift between these diverse and complementary sources of liabilities that will help us fund growth. In this period, we've also raised over 5,500 crores of bonds while being extremely prudent about pricing. And just because we built a strong pipeline well in advance in Q3 itself, we did not need to resort to any forced borrowing when rates started rising in the middle of Q4 fiscal 19. Through the last 6 months, the competitive landscape has become less cluttered. With the much-awaited GST cut coming through, the housing market, especially in the affordable housing segment, has now strongly picked up April onwards, and we are perfectly poised to make the most of this. We are also very excited with the SME lending opportunity in the country, especially given the bank merger and amalgamation process that we are pursuing. Self-employed underwriting has been a core competence of IBH. We are pioneers of the LAP product in the country and have over 13 years of experience in this product. The LAP product has seen 5 business cycles and has demonstrated credit performance through the global financial crisis and recently demonetization, GST transition, and also the liquidity squeeze of the last 6 months. Mandatory filing of GST returns for SMEs with turnover of over 40 lakhs will prove to be a game changer as a credit opportunity. Ready availability of GST returns for verification will make underwriting a loan for a product as complex as a LAP very quick affair. This is expected to be a catalyst for growth of lending to SMEs. While the MSME sector contributes to 37.5% of the country's GDP, it is allocated only 4% of the financial system's credit. This is indicative of a large opportunity for growth in this industry. With the digital lending market in India expected to reach about 1 trillion in 5 years, technology-backed, quick and efficient MSME lending is bound to experience a substantial boost in the coming years, and we are well poised to take advantage of this. I will now get into the numbers for the quarter. I will request you to keep the earnings update handy. Kindly refer to slide 4 of the earnings update. The net interest income, excluding sell-down upfront income, the upfront income that we get out of securitization transactions, for fiscal 19 stood at rupees 6415 crores, which is a growth of over 7.6% over FY18 net interest income of 5960 crores. For quarter 4 fiscal 19, NII is at 1591 crores, a growth of about 5.8% over quarter 3 fiscal 19 of 1504 crores. Again, we have not taken the sell-down upfront income in this NII. The sell-down upfronted income was 244 crores in quarter 4 fiscal 19. Our PBT growth for fiscal 19 was 24.1%, with PBT growing to 5604 crores from 4515 crores in fiscal 19. The tax rate for the company was significantly higher, as was discussed in the last quarter, in both quarter 3 and quarter 4. The tax rate for quarter 4 has increased from 11.7% to 29.9%. This was on account of one-time redemptions in some of our historical investments. And as a result, the profit after tax was impacted due to this one-time tax incidence of about 291 crores. We have demonstrated in the past that we are an efficient pass-through model for rate changes. Increase in cost of borrowings have been promptly passed on, and the full effect of this came through in Q4 with NII expanding by 5.8%. I am also very pleased to announce that the board has approved a dividend of rupees 10 per share. With this, we have paid out total dividend of rupees 40 per share during the fiscal year 2018-19. Now, please turn overleaf to slide 5 of the earnings update, where we have presented our performance on certain key parameters during the liquidity crisis of the past 6 months since September 21st up until 31st of March. Our spreads remained strong during this period to stand at 3.42% as compared to 3.11% last year. Our total commercial paper is now down to only 4% of our funding. Our net worth has gone up to 18,284 crores. Over the past 6 months, portfolio sell down has helped us sustain a very conservative gearing level, with the net gearing at only 4x at the end of quarter 4 fiscal 19. Sell down will continue to ensure that gearing remains conservative, but retained spread on sold down book will sustain profit growth and healthy ROE levels. Our capital adequacy at the end of quarter 4 fiscal 19 stood at 26.3% versus a regulatory requirement of 12%. We've also raised $270 million of ECBs during the year. We are incrementally looking to increasingly utilize this source of funding and increase its share in our overall funding mix. We are targeting to raise between $350 to $500 million of overseas borrowings in quarter 1 fiscal 20 and $750 million in the full year. Now, if you could please refer to slides 5 through 9 of the earnings update, where we've updated our quarter-wise ALM for the next 10 years. As was the case last quarter, the net cash number for us, which is the last row, is significantly positive for every quarter for the next 10 years. Our cash levels are as high as covering our 12-month debt repayment up to 1.3 times without considering any repayment from our loan portfolio. The repayments in our loan portfolio last quarter were 7,900 crores, and for the last four quarters, the average is almost 7,000 crores. Without including any of that 28,000 odd crores of repayments that we get, even then we are covered to the tune of 1.3 times, assuming no fresh borrowing. So that's the kind of safety and stability that we built in the quarter-wise in the ALM. Please now turn to slide 14 of the earning update. Our stage 3 assets and hence gross NPA are at 0.88%, while the remaining 99.12% assets are in stage 1 and 2. We have rupees 728 crores of ECL provisions against stage 1 and 2 assets and provisions of 228 crores against stage 3 assets. Our gross NPAs have remained below 0.9% for 31 quarters now. Moving on to the liability profile, I request all of you to turn to slide 19 of the earnings update. You will see on slide 19 that we have significantly brought down reliance on CPs to only 4% now, and in the process ensuring a well-matched ALM and durability of our liquidity levels. If you turn overleaf to the next slide in the table, you will see that of the total borrowings, portfolio sell down along with bank borrowings and ECBs have been the source of incremental borrowings for us in the past year. Sell down has been our biggest source, helping us decrease our reliance on CP as we brought it down to within 5% of the funding mix, which is the desired principle. Moving on to slide 21, we have presented the details of the high quality retail loan book of 54,044 crores sold down in as many as 200 pools. The performance of these pools is monitored on a monthly basis at an account level by the rating agency CRISIL. Only 15 PTC pools are monitored by ICRA and CARE. After an average of 23 months on books, the 90 and 180 plus delinquencies of these books, as is noticeable in the report, are negligible. IBH has always been one of the largest sellers of mortgage pools, and the loan sell downs is a long-established source of funds for us. Sell-down helps us maintain conservative leverage while growing our total loan assets and retaining the spread. Sell-down also helps us maintain a healthy ROE. Over the past 12 months, we've sold down 22,347 crores of loan assets. This builds on our strong historic sell-down track record, where to date we have sold down loans in excess of 65,000 crores. In fiscal 18, we had sold down loans in excess of 10,000 crores. And because we had been doubling the sale of loans over the last 2 to 3 years, we were again able to double from fiscal 18 to fiscal 19. Sell down in fiscal 19 was obviously our highest ever sell down recorded for a financial year. This sell down has happened across products and segments such as affordable home loans, high ticket home loans, plot loans, LAP loans, as well as developer loans. It was for the first time in India last year that a lender has been able to securitize large assets to banks, thereby giving liquidity and into an asset pool, which is otherwise considered to be highly illiquid. The acceptability of IBHFL's granular loan book portfolio across investor base, including all kinds of banks, is a testament to strong portfolio quality and strength of our underwriting capabilities. Amongst our securitization relationships, the bank now counts 16 PSU banks, 6 private and foreign banks. We are focused on capital conservation, and selling down loan assets is extremely capital efficient, freeing up capital while retaining spreads, making this transaction highly ROE accretive. As we move towards 2020, portfolio sell down will contribute to an increasingly larger proportion of our funding mix from the current 22%. Now kindly turn to slide 25. We now move to the spreads of our business. Our spread on loan book for Q4 fiscal 19 was strong at 3.42%. Loan book yield at 12.15% against cost of funds on stock of borrowing at 8.73%. Again, as I mentioned, we operated as a perfect pass-through vehicle and passed on all of our increase in cost of funds very efficiently to the borrowers. These numbers of fiscal 19 and these financials assume special significance, as shortly they will be submitted to the regulators and other statutory bodies in our application for merger with Lakshmi Vilas Bank. As a part of the merger process, the balance sheet and loan book of fiscal 19 and the related financials will form the base documents for regulatory and other statutory inspection and scrutiny. We remain very confident and look forward to the next steps in the merger process. Merger applications are being filed with respective regulatory and statutory bodies. A dedicated team is also working on transitioning IBH's business and balance sheet to come under banking regulatory norms. The amalgamated bank will build on IBH's strength and focus on the vast housing opportunity in India, and it will also build on IBH's expertise in self-employed lending to focus on the equally vast MSME lending opportunity. In the meantime, till the time that this merger is effective, we continue to be a very focused housing finance company, and for us, it is business as usual. Towards this, I wish to reiterate, we are fully back into the growth mode and in line with our pre-September 18 disbursal levels, where we used to disburse around rupees 10,000 crores a quarter. In quarter fiscal 20, also we will be disbursing around 10,000 crores. On this note, the IBH management team is now open for questions. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Shubhranshu Mishra from BOB Capital Markets. Please go ahead.
Hi, sir. Thank you for the opportunity. I just wanted to understand the disbursal mix in the fourth quarter. What proportion is from home loans? What proportion is from LAPs, and what proportion is from the construction finance? That's my first question, sir.
So it's roughly 50, 30, 20 between home loans, LAP, and developer loans.
And these are fresh sanctions, or these are like a renewal in the construction finance, sir?
These would generally be sanctions of our existing loans. There would be a couple of new loans. The rest would be where we have to continue to disburse on projects which are under construction.
Right, sir. Thank you for that, sir. My second question is with respect to any specific account recoveries, like you mentioned in the previous quarter that you had recovered certain amounts, and there were certain accounts which were under litigation. Any particular accounts which have been recovered in this particular quarter, sir?
So specifically, if you're talking of Palais Royal, that is still underway. It hasn't progressed to the extent that we thought it would, but we have made legal progress on that, and that legal progress, the outcome of that you would start seeing over the next 48 hours. So we are still quite hopeful that in the very, very short term, our recovery to a higher extent to what we had projected. So we had projected that we will recover over 3 years. Now with the revised legal orders, we are hopeful of being able to recover much faster. As for other recoveries, they would be normal course of business. So we have recovered. We have also, given our higher securitization income, continue to provide aggressively. So between all of that, it is pretty much in course of normal business.
Right, sure. And my last question is with regards to the CP rollover. How much of CPs would come over for rolling over on the April 30th, sir? What quantum would be that?
April 30th is, we have no CP rollovers due on 30th of April. Over the next 90 days, around 4,000 crores will come up for rollover, which is all factored into the ALM, and in our ALM we assume no rollovers.
Sure, sir. Thank you so much for your time, sir.
Thank you. The next question is from the line of Piran Engineer from Motilal Oswal Securities Limited. Please go ahead.
Yeah, hi sir. Congrats on the quarter, and I just had a couple of questions. Firstly, this net gain on fair value changes of negative 133 crores. What exactly would that be attributable to?
Which number are you referring to exactly?
So revenue from operation section 4 minus 133 crores.
No, so This is credit cost essentially.
This is credit cost. I thought impairment of financial instruments.
No. So net gain on fair value is notional loss on units which we had invested in mutual fund, and there was a dividend on that. So there is a notional loss because of that.
And the dividend income line, if you see, is accordingly bumped up by 471 crores. So it is extraordinarily larger.
Okay. And so then in this quarter, what were our sell downs and what was the income associated with it?
So our income, as I shared, was about 244 crores, and we sold down a little over 6,000 crores.
So that 244 crores comes in the interest income line, is it? Because now we have changed our methodology of disclosure, so I just want to be clear.
Yes, this 244 crores will be part of the interest income line. And when we are detailing the net interest income, etc., we are excluding this 240.
Okay, got it. And just lastly, on your comments on Palais Royal, so the 200 crores we haven't received this quarter, is that correct?
No, we received the first installment and then we did not. So we have proceeded with the litigation and we've received the necessary orders to take over the project, and we are, I think, either tomorrow or day after, releasing the public notice to take over the project.
Okay, because the reason I ask is that on an absolute basis, our GNPLs have increased by 75-80 crores during the quarter.
Yeah.
And if we have received 200 from Palais Royal, that means we must have had some slippages of 270 to 80 crores.
I said we received the first installment of that 200, so we received about
how much was that?
25 crores, and then we did not receive the balance. So we pursued the matter in court, and we got the order, I think, a few days ago, and now we are releasing the public notice for the auction, etc., over the next couple of days.
Okay, but this developer is under liquidation, is that correct?
Let the developer be under liquidation. The order is under SARFAESI, so we take over the project under SARFAESI.
Okay, great. Good to hear. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Hi. Just one clarification. The sell down income of 244 crores, this is reflected in the interest income of 3,700 crores, right?
That's right.
Okay. And if you could share the the sell down income booked upfront for the entire year.
Okay, give us a minute. We'll just come back to you on that. It would be in the handle of 900 crores. I'll come back to you in a minute with the exact number. We can move on to the next question in the meantime.
Sure. And just one last point. If you could explain the tax case because of which your liability, I think you mentioned, went up by around 290 odd crores.
Yeah. So the exact income on securitization is 914 crores. The tax incidence is on account of redemption of some long-term units. Ashwini will just explain how does that whole thing work.
So essentially these were, a few years back, 4 years back, there was some bonus unit that came. So the bonus units we were carrying as a long term, and since their cost is zero, so the entire amount when they were redeemed, there was a tax incidence. So it was one time, so there is no such other long-term investment which has, the base being carried at zero.
Sure. Those were my questions. Thank you very much and all the best.
Thank you.
Thank you. The next question is from the line of Kunal Shah from Edelweiss. Please go ahead.
Yeah. So on sell downs, looking at the trend which was there in last 2 quarters, and now incrementally, what is the kind of run rate which we are looking at, and ideally the spreads which were there earlier in last 2 quarters, and maybe going forward, if you can just guide in terms of whether the spreads would be similar or it would be relatively lower.
The spreads have actually improved from quarter 3 to quarter 4, and my sense is that now they will pretty much track with the improvement done. They will pretty much track the the movement in interest rates. If one is to expect that interest rates will stay benign, then they should only get stronger from here. The number that we will now be targeting, as I'd explained in the previous quarter call, our long-term average would be between 3 to 4,000 crores. Our longer-term expectation of income would be in the handle of 150 crores, and anything above that we would generally try and use for provisions.
Okay. And when we say give the spread, so does this include the assignment income on this?
Right.
Is there with respect?
Yeah, but not treated as upfronting. It is treated as, if we are getting X percentage from the customer and paying Y% to the bank, so it is X minus Y. We are not taking spread as total revenue minus total expense. I hope I'm clear.
So when we look at it maybe in terms of the 900 odd crores, 914 odd crores for the full year of FY19, that entirely would not have got factored in when we are saying 3.42% spread.
That's correct.
Okay. And secondly, in terms of the overall sentiments in the real estate markets, and given the liquidity which is there with say few of the corporate developers, so what broadly we are seeing in terms of the resolution or maybe the collection mechanism which is largely being followed. So are we maybe incrementally as compared to that of say what was there in October and November, how we are seeing the liquidity situation on the developers wherein we have funded, and if maybe they are facing any kind of an issue, then what is the sort of resolution which we are working upon, be it in terms of like selling down the inventory or maybe the change of the developers in few of the projects if needed. So what is like the major I would say the major mechanism which is followed over here?
So again, as I had explained the last time, I will go through the construct of the portfolio. The portfolio largely hinges on rent discounting transactions. So our endeavor over the last 3 to 4 years, ever since fiscal 14, now actually 4 to 5 years, back in fiscal 14, on a similar investor call, I had said that we are extremely concerned about premium real estate, and incrementally we will go very, very slow on the same until the time that we can come back with a revised model. And we came back to all of you with a revised model about a year and a half later, which was a model which still continues to hinge on rent discounting. What rent discounting does is it captures the most prime asset of such a developer. B, and in our last earnings release, we had also listed down a few of the assets that are mortgaged to us as rent discounting transactions. And it also provides for equity support. As is quite evident, and you would be reading about it in the papers every day, there are commercial transactions which are happening. Now with the REIT of Embassy Blackstone also getting listed, that whole market has become even more lucrative. The REIT is trading at sub 8% levels, so there is a lot of interest that is there in that whole commercial real estate space, which is obviously helping us a lot because these assets have tremendously increased in value. So the whole model is that we try and first do a rent discounting, and then also if there is a construction finance opportunity, do that. Generally, the assets that we do are, including the commercial construction finance assets, would be catering to the mid-income group and would be assets in cities that you would recognize. The mid-income segment continues to be pretty robust in sales, and apart from something very selectively getting stuck for either litigation or a peculiar permission or something like that, it is generally the mid-income segment continues to see traction. Since a lot of people on this call would be familiar with Mumbai, in Mumbai anything which is priced at about 9 to 10,000 rupees a square foot continues to sell in a pretty robust manner. It is only assets which are priced at north of 20,000 rupees a square foot that continue to struggle on sales. In such assets, our presence is very, very small. As for strategy, our emphasis is to continue to support the developer where there is good sales traction and construction progress. If we are seeing that, the project requires equity, then we ensure that the commercial real estate building gets sold and equity gets released. And if we feel that the brand needs to be supported, we either replace the developer or find a suitable structure which will boost sales. We've adopted all three models, and this quarter was pretty critical from making sure that asset quality, etc., stays healthy. I'm very happy with the outcome as far as this quarter is concerned. So we are quite confident that the portfolio will continue to behave and will not give any kind of an alarming outcome, either causing any massive pressure on profits or on delinquencies anytime in the near future. Fairly confident about how the portfolio should behave.
Okay. And on the corporate mortgage side, 17%, which is equivalent to 20,000 odd, if we can just broadly break it up into LRD and the pure construction finance?
It would be roughly 50-50.
Okay. Yeah. Thank you.
Thank you.
Which is the pure breakup, on standalone assets, but these assets are also all cross-collateralized. So over 70% of the portfolio in that handle will continue to be supported by a rent discounting transaction.
And average ticket size on this 10,000, 50% of the construction finance?
Would be about 200 crores.
Okay. Yeah. Thank you.
On construction finance will be slightly lower. On the overall package will be about 200 crores.
Okay. So on 20,000 it will be 200.
Yeah.
Okay. Okay. Yeah. Thanks a lot.
Thank you. The next question is from the line of Adarsh Parasrampuria from Nomura. Please go ahead.
Hi, Gagan. Thanks for taking the question. Question on the NCD funding. Quarter on quarter, there is like a 7,000-8,000 crore drop in that side of funding. Obviously, there would have been some maturities. Just wanted to understand, that's the lagging part in terms of the money raised, right, in the last maybe 6 months. Obviously, the market's been shut for a few months initially. What's the outlook there in terms of what you can raise, and also for the next, say, every block of 3 months, like you quantified for CPs, can you quantify what's the NCD maturity that we have over, say, quarter 1, quarter 2, quarter 3, and quarter 4 for next year?
So I don't know where you got that 7,000-8,000 crore. For the full year, we've had only 2,000 crores of reduction in our bond stock. You're probably confusing it with, because earlier in the liability breakup, bonds and CPs used to be together, and they were called debentures and securities. Now we've broken it up. Debentures and securities, which is bonds, is reported separately, and CP is reported separately. So what used to be 54% last year is now 40%. But in that, 8% decline comes from CP. So CP is what has massively declined, and CP has declined by as much as almost 9,500 crores, which is an intentional strategy. As far as funds raised is concerned, on an absolute quantum, as I mentioned at the start of the call, it is 51,312 crores, of which bonds themselves are about 5,500 crores. And then bank loans are about 14,500, securitization of over 21,000, and CP, which gets rolled over every 3 months on a gross basis, is about 10,000 crores. So for us, over the last 6 months, all the instruments have been working. We have also been slightly proactive. So if you recollect, by December itself, we had put together a liquidity buffer of over 21,000 crores. So a large part of our borrowing program, which was required for the full year, was completed in quarter 3 itself. And being in a rate-sensitive business, we have to be extremely conservative. So when rates and corporate bond spreads went up in February until about mid-March, we had to be extremely conservative. As far as April is concerned, we've already raised, if I'm not mistaken, in the handle of 600-700 crores of bonds in the last 2.5 weeks, and by the end of April, I expect to close another 300-400 crores of bonds. And we are also looking at doing an overseas issuance very shortly. So that should get us to 3,000 crores. So overall funding outlook is stable. We still continue to be extremely, let's say, conservative about liquidity, and we shall continue to remain so. There are enough concerns out there in the marketplace, and as I had mentioned in our previous call, that for us we will prefer safety over everything else. So that's the core model. But as far as ammunition for growth is concerned, we already have enough, and on an incremental flow basis, we are getting enough across all kinds of sources, which is why I have repeatedly stated over the last few minutes that we are back to normal levels. In quarter one fiscal 19, we had disbursed about 10,000 crores, and in quarter one fiscal 20, our target is also to disburse about 10,000 crores, so which is pretty good for a first quarter. So I hope I have answered your question.
Yeah, Gagan, sorry, just getting back, right? So I was just looking at our December presentation and just comparing it to the March 19 presentation. So there I see the debenture and securities line is about 56,800 crores.
If you look at the bottom table, that was only 3-month commercial paper. The rest of about 3,000 crores of commercial paper was in debentures and securities.
Okay, so that's been netted off, is it? Okay. Okay, and the second thing was I just asked if you can just give some sense of bond maturities for FY20, NCD maturity. Sorry if I missed that number in your reply.
NCD maturities in fiscal 20?
Yeah.
So our total maturities, including all CPs, are there, which should be, which is a total maturities of. So we have total maturities of about 24,000 crores this year, of which about 5,000 crores is CP, and the balance 19,000 crores will be split between bonds and this thing. So our maturities will be about.
Bond maturity is about 10.
Is about 9,000-10,000 crores.
Perfect. Sounds good. Thanks a lot. Yeah, bye.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Anita Rangan from HSBC Asset Management. Please go ahead.
Yeah. Hi. Good evening. Just wanted to understand what would be your average yield in the overall investment book. The reason why I'm asking is just want to understand across your various investment categories, would the mutual fund investments be in like largely liquid funds, or because you mentioned T1, T2 basis, would it be in liquid funds or a spread across, short duration, or would there also be some closed-ended funds here? And what kind of yield, average yields you are expecting on the investment book?
The bulk of it would be liquid funds, and the investment book would be yielding us 7.25 today.
Okay. And within your current account balance and FDs, would it be largely to current accounts or FDs, and what will be the
current accounts is a very end of the quarter phenomena, and generally speaking, most of it is in fixed deposits. So, for example, yesterday we had close to about 12,000 crores in bonds and the rest in CDs. So either we put money into mutual funds or CDs. So let me just give you yesterday's breakup. And we made some long-term FDs because some banks were offering attractive rates. So, for example, yesterday we had about 154 crores in mutual funds, about 11,000 crores in CDs, and the balance would be split between bonds such as NHB, PFC, etc., and fixed deposits.
Okay. And also wanted to understand in terms of overall balance sheet degrowth, like there's a marginal degrowth, which we all understand. given the overall market scenario. So going forward, how are you seeing, which segments would perhaps grow faster than the others? And overall in the developer segment also, just pure developer lending, wanted to understand what is your outlook here and what you actually, mean by saying construction finance also has LRD cross collateralization. That's something I didn't understand clearly.
Okay, so while as an overarching theme, we will, because this is an year where A, we are coming back to growth, B, we are also transitioning into a bank. So we will have to manage growth with the transition into a bank, and therefore our emphasis would remain on the housing lending and the SME lending. We have to make our overall portfolio align with what it should be looking like for a bank, and therefore the emphasis on CRE per se would be very limited. Fortunately, our construction finance exposure as a percentage of our overall book is also very small, in line with what most banks have as CREs. Just the pure construction finance part. Most private banks have CRE, so there's not a lot of work that we have to do, but we can't grow that book by a lot. So at a very headline level, loan AUM should be growing by around 20%. Balance sheet will be growing by about 10%. And within the loan AUM, the emphasis would be to focus on the housing and the SME opportunity incrementally, even as a housing finance company, while we transition to a bank. On the other question, which is, LRD and construction finance, so I tried to explain it in detail last quarter. So if you can review that transcript, it will be perhaps very useful. But I'll just explain quickly again that when we initiate a relationship, usually we initiate it with a developer by taking as a mortgage their prime commercial asset, which is generating rent and does not have an execution risk. So a steady cash flow is coming. And once we are comfortable with that asset and with the developer, as a second exposure, we will take on exposure on some construction opportunity where some building is coming up. It would largely be a residential building. In very few cases, it could also be a commercial building, and all of these assets would be cross-collateralized. So this is what we meant, that 70% of the portfolio is supported by rent discounting transactions.
Okay, got it. Yeah, thank you very much.
Thank you. The next question is from the line of Hardik Shah from Max Life Insurance. Please go ahead. Hardik, your line is unmuted. Please go ahead with your questions. As there is no response, we move to the next question from the line of Utsav Gogirwar from Investec Capital. Please go ahead.
Thanks for the opportunity, sir. I have a couple of questions. First, can you share the on-book and incremental lending across segments, home loan, LAP, and developer?
So, as I mentioned, we've done a very unique transaction, both in quarter 3, both in quarter 3 and quarter 4, where we've also been able to assign some of our developer loans, trying to ensure that whatever securitization we have done through fiscal 19 is pretty representative of how the book is split 60-20-20 between home loans, LAP, and developer loans. So that's pretty much the split. So give or take a couple of percentage points, it's fair. Both the books are a good shadow of each other, and that's what we will continue to endeavor to do. So even in quarter 1, the couple of transactions that we've actually initiated in April are the large loan transactions. We haven't yet done securitization of the smaller loans, which we will in due course of time. But that's the kind of a focus that, however, the overall larger AUM is, even both the on-book and off-book should be a pretty close representation of each other.
And sir, how is the yields on these segments?
The spreads when we sell down developer loans are obviously finer than...
Sir, my question is on the yields on segment, which is home loan, LAP, and construction finance.
Sure, I'll give it. One second. So on stock basis, our yield is at about 12.15%, about 10.5 for home loans, LAP at about a little over 14, and sorry.
And construction finance?
Okay, sorry. I said some other number. The yields are on home loans, it is at 9.85, LAP is 13.1, and commercial loans will be at about 15%, LRD at about 10.9, and construction finance is 15%.
So these are incremental?
This is incremental. Book will be 10.5 for home loans, LAP at 14.5, and commercial loans at 15.5.
And so, lastly, how many? What are the number of developers we have lent to? Total number of developers.
Total.
And some color on how much will be the share for top 5, top 10 developers in our overall construction finance business.
So we would have around 40 odd developers, and top 25 developers constitute 75% of the portfolio.
Okay. Thank you, sir. That's it from my side.
Thank you. The next question is from the line of Sneha Ganatra from Shubhkam Ventures. Please go ahead.
Sir, just wanted to know on the growth outlook for the next year and what will be the profit growth target for the next year. And on the liquidity, we would be continuing that much amount of the cash and cash balance, or any changes is expected?
So the liquidity that we have is clearly excessive, and is part of it is for growth capital, and so we are already in some sense funded for Q1, which is what gives me confidence. But that said, with so much of noise in the system, one will continue to be extremely conservative about growth, etc. So on growth, we are targeting a 20% kind of AUM growth, a 10% kind of a balance sheet growth, and high teens of profit growth. As things are, we are pretty confident that we will be able to achieve this, but we will also calibrate growth on the basis of safety definitely comes first, and we are all well aware that there is so much of news flow around A group and B group and C group. So keeping all of that in mind and hoping that the system does not go into a lockdown mode, optimistically speaking, these are the kind of numbers that we would be looking to pursue. From a liquidity perspective and from an ALM perspective, we are extremely well set. If anyone in the industry is, we are well set. Even from a flow point of view, we are very confident in terms of new monies coming, and I do not think that there would be more than one other balance sheet which can talk about having raised as much as 50,000 crores in the last 6 months. No one else other than one name would be in a position to say that such large funds have been raised and raised across all kinds of instruments. So to that extent, from this flow and from the success of the last 6 months, one has the confidence to say that we are back in growth mode. But again, one would be very, very careful.
And this 20% AUM growth, whatever disbursement growth are we looking, because there would be prepayments also happening over a period of time?
Disbursal growth would be slightly higher because last year in Q3 our disbursals were extremely muted. I can come back to you in a minute on that number.
Okay. And on the CI fund, cost to income ratio, because this time we have seen a sharp decline in the employee as well as other OPEX. Anything to look into that?
Decline?
Yeah.
There is
quarter-on-quarter basis, yeah. Quarter-on-quarter.
Cost income ratio is at 12.7%, which should come back. It should come to around 12% levels for fiscal 20.
Okay.
Sorry? No. what is the gross disbursal that we will do in fiscal 20? Yeah, please, let's go to the next question. We are just coming back to you with that number.
Thank you. The next question is from the line of Shashank Savla from Lion Trust Asset Management. Please go ahead.
Thanks for the call. Just regarding the cost income ratio, which has risen slightly this year and after a very good trend of falling for the last 6, 7 or odd years. And you also had mentioned a target of getting it down to single digits. I don't know what the time frame was. So can you explain the reason why it's jumped up, and have you pushed back your target of getting to single digit cost to income ratio now?
Yeah, so the cost to income ratio has risen a little bit because our disbursal and related fee income was lower, but we did not allow our employee costs or our investments into branches and our home loan platform and all of that did not go down. So as a result, the costs on a smaller base this year was on a relatively smaller base was marginally higher. The trend down would continue, and we would continue to improve it in a normal year by 70 to 100 basis points. So now that we are at 12.7, it will take us 3 years to get to single digits.
Right. And regarding the dividend,
that is assuming that we that is under a housing finance company model, but one is quite confident that the housing finance company model would transition into a bank model, and then the cost income ratio would be looking very different. So for fiscal 20, one is confident of a 70 to 100 basis points reduction as we look to grow the housing finance loan AUM by about 20%. And as we transition into a bank, then we will have to come back to you with revised projections for that.
Right. And for the bank transaction, just trying to understand the time frame of how long do you expect the approval process to last? And during that time, would you continue to pay 50% payout ratio, and would that ratio change if you have a merger with the LVB bank?
Yeah, so as long as we are a housing finance company, which I expect that for most of fiscal 20 we would be a housing finance company, the payout ratio would continue to be at 50% of profits, and profits will only get better from here. So that number, which is currently at about $10 a quarter, is quite stable. As for the timing, what was very important was to get the audited financials behind us. As I mentioned, these paid notes and P&L, balance sheet, etc., would form the part of the base document around which the entire regulatory process across all regulators would run, and therefore it was important to get this behind us, and a lot of effort has gone in over the last few months to be able to prepare this in quick time in a very, very diligent manner. So we've done that, and this is behind us. So now we should move very rapidly as far as making various applications are concerned, and then the process will take its own time. So as we had mentioned on the call, we expect the process to take about between 6 to 9 months.
And finally, more on the strategy part. Once, let's say, if the merger is approved with LVB, what sort of the merged entity, what will it look like? Will you still be sort of raising deposits through LVB, but primarily be lending out for home loans, or would you then venture out and try to become more of a universal bank competing with other private banks?
Given a very strong capital base and a very strong distribution and an extremely good starting point of over 30,000 crores of term deposits, I think we will be well positioned to quickly become a universal bank, but a universal bank with a focus around housing and SME. So a universal bank would mean that we would also emphasize to upsell and cross-sell to these retail customers and fully lever on the fee opportunity around that. Do we see ourselves as becoming a project finance bank? If that includes being a universal bank, that's not something which is on our immediate charter. I think SME is a very unique opportunity. Housing is something that we already do at a very large scale. SME is something that we've done over the last decade and a half. That portfolio has done extremely well. It's a very profitable portfolio. And even through this period, it is a portfolio which has helped us sustain our profitability. So within all of that, as we, reduce our dependence on commercial real estate, it will become an even important asset class. And therefore, we would be a SME and housing focused bank. And then step by step, we will move to other asset classes also.
Right. Okay. Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question.
We'll just take one more question and then we'll have to get along.
Sure, sir. So we'll take that question from the line of Shubhranshu Mishra from BOB Capital Markets. Go ahead.
Sir, thank you for the opportunity again. Just wanted to understand your liability strategy as a merged entity, as a merged bank. How are you going to scale up your liability franchise going forward?
So it's still very early days, but as I mentioned, with 550 odd branches and with our 250 coming in, we will have like 800 branches. For a balance sheet or loan assets of about 25,000 crores. The bank already has deposits which compare with banks which have loan assets 4 to 5 times the size of LVB. So it's a very, very good starting point. They have a good retail franchise in the south. We have a good retail franchise pan-India. And as the success in our retail bond issuances has shown that we are able to attract reasonably high sums of money through retail bond issuances. So we should be able to tap that same market for term deposits and CASA and so on. So it would be a classic strategy where one would depend on term deposits and slowly build up CASA, both by a physical presence of 800 branches, which is also a very large presence for a bank of this size. The combined balance sheet would be in the handle of 1,50,000 crores. So for a balance sheet of that size to have 800 branches is a very good starting point. And the other thing is that with the success that we've had in our digital strategy at Oak North Bank, we are confident of being able to develop that into a full-blown strategy in India as well. So that would be the other way that we would be looking at raising resources. So, but the model would be around CASA and term deposits, etc. SME also is an area of government focus, and therefore there are several nodal agencies which give a lot of refinance. And given our high capital and our existing exposure in the overseas market with our ECBs and masala bonds, and with the dollar bond also coming, we should also be able to tap that market. So we would keep a pretty leveraged strategy as we have a very diversified strategy as we have a diversified strategy at Indiabulls Housing.
Right, sir. Sure. Thank you for your time, sir. Best of luck.
Thank you so much. Thanks, everyone. And just to conclude, Indiabulls Housing continues to focus on making sure that our ALM is the strongest. Our liquidity levels are extremely high and comfortable, and that gives us confidence that now the time has come to start growing again, and that's something that we would we are looking forward to do from Q1 onwards. The bank opportunity is also a great opportunity into which a lot of work is going on, and hopefully we are making very good progress, which will become quite visible in the days to come. So on this positive note, I thank you again for your support and look forward to speaking to you in the next few months. Thanks.
Thank you very much. Ladies and gentlemen, on behalf of UBS Securities.